Good morning. I'd like to talk to you today about opportunities in real estate and answer the question, why is it that so many people invest in real estate? So let's get started, and I want to just right off the bat discuss some of the opportunities that I see and that we bring clients in and see them check real estate to see if it might be the investment for them, and we're going to compare it to some other investments and just have a discussion about real estate as an investment. So the first thing I want to talk about is why the 4 reasons that people invest in real estate. And so what happens to us is we get calls from people and they have some disposable income or they have some needs to pay for something in the future, and they want to build net worth. They have a lot of different needs that they want to satisfy that real estate might fill that box. And so the very first one that we look at and we analyze is income. So income in real estate generally comes from rents. And so we start to look at the investment from a rent standpoint and a net income standpoint and see that it just makes money. You know, does it produce cash at the end of the month? There is a lot of people, most people prefer to have income at the end of the month. So that's the very first one, is income. The second one is appreciation. Appreciation is an increase in value without any quote work. So this just happens over time. The appreciation that we generally see is highly correlated with inflation. And so we always say that real estate is a good hedge against inflation because of that correlation between real estate values and inflation. So during the time period that we're in right now, which is an high inflation period, those that have investments in real estate tend to do better. Those that are not in real estate don't do as well. It's really key right now to own your own home instead of renting. Renting is not as advantageous during inflationary periods, okay? So appreciation is the second one. So you have income, you have appreciation. The third one's not so simple. It's called value gain. Now, as opposed to appreciation, value gain takes the energy, the efforts, and the talents of the ownership in order to do something to change the asset to build the value. So in this particular case, maybe we're buying an apartment complex and we add a pool or we take a pool out. We add a park, we add some placemaking, we add a gate, or we take a gate away, or we add some parking, remove some parking, redo sidewalks, remodel, anything that we can do to increase the value, to increase the rents, because increasing the rents will increase the value. We call that value gain. That is the work that the property management does in order to increase the value. Okay, so now we have income, we have appreciation, and we have value gain. The fourth one, you don't see nearly as much, and that is the value that you gain in equity. And I call that equity gain. Okay, so the payment that you pay is your principal and your interest if you have a loan on the property. And so the principal is called equity, and that goes on your balance sheet as an equity gain. The interest that you pay will be deducted on your financials and your cash flow. So the principal is the part that we're talking about here, and we call that equity gain. All right, so we have the income, we have appreciation, we have value gain, and we have equity gain. Those are the 4 reasons that people invest in real estate. So it's up to us as real estate brokers, or us as property managers, or if you're an investor, then you need to analyze your needs. So the property manager, the broker, is going to analyze the needs of the client to try to figure out which one of these things best fits their situation. Because then what we can do is we can go and we can look for investments that will actually produce income, appreciation, value gain, and equity gain. So that's sort of the game that we're playing here, is to try to figure out and try to fulfill the needs of either ourselves as an investor or our client if we're a property manager or a broker. All right, so there are also assets that we could purchase or put our clients in that would actually fulfill all four of those. And so maybe that's their desire, is to do all four. So you think, why would somebody not want a lot of income, and why would they want appreciation? Well, that might be a tax reason. There are some tax advantages to deferring that income and not collecting that income in the way of income, net income, and foregoing that in the way of appreciation for tax reasons. So the next thing that we talk about in this discussion is the Great Recession that we went through in 2008, 2009, 2010, what that did to the market. And then I want to talk a bit about sort of the pandemic period that we just came out of. So what we saw during 2008, 2009 is we saw what we refer to as a bubble. A bubble is nothing more than inflated prices for, frankly, no fundamentally good reason, meaning that it won't continue. It's not sustainable. So what we found during that period of time is we had a run-up of values, and it wasn't sustainable. It wasn't justified by rents that we were receiving. And so what happened was values decreased. And when values decreased, people couldn't service their loans. And a lot of that real estate went back to the bank, which caused financial failures. And we called that the Great Recession. That was frankly caused by low interest rates, trying to solve some problems that were created in 2000 in the dot-com crash. They were trying to come out of that recession. They did so on the backs of real estate with low interest rates. The low interest rates caused the housing bubble. The housing bubble caused the financial crisis. So we had this circle come full circle and into the pandemic days. The government put a lot of money into the market or into the society, into people's hands in the way of gifts, basically, to try to prevent us from going into a recession and to have what they were referring to as a soft landing out of the pandemic. What that caused was it caused a lot of money in the market, and so a lot of people bought real estate, and so we again saw inflation. And that inflation we see with increased prices in rent. We see that increased prices in real estate, and made markets completely unaffordable. So right now, today, if you ask me to evaluate where we're at in real estate, I would say that we've created an unaffordable product. And so we don't have people with the current incomes to afford most of the product that we're producing. Okay, whether it be rental or whether it be for purchase. And so we have this mismatch going on right now in the market that will eventually, hopefully, correct itself. Either we're going to end up getting higher incomes, or we're going to adjust the prices to match the current incomes that people are receiving. So we're in this very difficult and weird situation right now where we don't have hardly anything on the market. We have very low inventory, we have very high prices, and we have very high, relatively high, they're not high in my lifetime, but relatively high, 7 or 8% interest rates. Most people would refer those currently as high interest rates. And so that makes it just a less affordable product because of the high interest rates and the lack of income adjustment for inflation. So that's where we find ourselves at today, and I just think we need to understand where we're at, and we will recover from that, and the economy will adjust for it, but we just don't know how long that's going to take. So let's talk about some other advantages of real estate. One of the things that real estate is known for, and a lot of people seek it out for, is tax advantage. Right now we have some really cool things going on in real estate that are really helping people with capital gains. A capital gain is a tax that you pay when you sell a capital investment, whether it be stocks, whether it be real estate, oil, whatever those capital assets are. If you sell those, then you have to pay capital gains. Well, there is ways that you can avert paying those capital gains and defer them. And one of them is called a 1031 tax deference. And so we could do that, and we can invest the money that we invest. We can take the money that we made, the profits that would be taxed as a capital gain, and we can invest that money into another real estate, what we call a like-kind investment, into a real estate play, and then we don't have to pay that tax. So that's one way. It's called a 1031 tax deferred. And so that's one way. A second way that's relatively new are opportunity zones. Opportunity zones, you can do something similar with capital gains. When you sell a capital asset, you can take those monies and you can invest those in designated opportunity zones. Those were zones around the United States that were declared in need of investment. And we actually have some in our region, Oklahoma, Texas, Arkansas, that are pretty lucrative, that are pretty nice investments that you can put money in. So that's a second way. So you got the 1031, you've got opportunity zones, and then just in general with real estate, we're able to deduct our interest payments from our income before we pay tax on it. So those are advantages. And then the investments that we put into the asset itself are deductible in taxes. So it tends to be, real estate tends to be a tax shelter that people enjoy. The second way is we use it as collateral. This is the only asset that I really know of that I could point you to that you could buy and utilize the asset as collateral for the loan. And so, you know, you can actually buy an asset and only put down 20%. And so then you have, you put down the 20%, and then you can borrow 80% from a bank possibly in order to make it. And then they'll use the asset as the collateral or the security for the loan. So that's the second way. So you got tax shelters, you got collateral usage of the asset. The other thing, land is tangible. You can actually go out and you can touch that land. You can see that land. You can see that land being productive. And so you can take an active role in seeing your investment work for you. Unlike the stock market, where typically you've got a fund manager or somebody making the decisions for your money, this is different in that you can actually go out there and you can make a difference in the investment itself. The last one I'll talk about in this sort of segment is the pride of ownership. We as owners tend to have other reasons investing in real estate. One of the ones that my wife and I invest in is we want to do it for our community. We want to make the community better. We feel like there are amenities that our community needs, and they need a place to run that business. And so we can own that commercial real estate and lease to those people and have that asset in our community. So you can do things with real estate to improve the community and just give pride of ownership. And so I think that that's another reason that people do it, is it's just a good way to pay back to the community, and you can have some pride of ownership in it. Well, what about the disadvantages? So those are some advantages to real estate. What about disadvantages? There are some. In fact, there are many. The first thing I would talk about is just the overall inefficiency of the real estate market. When I say inefficiency, what I mean is the closing process. It's expensive. You have a lot of commissions, you have closing costs, you have insurance, you have things that you have to do at closing to transfer the ownership or convey ownership to the new owner that are quite expensive. Surveys, all kinds of things that frankly you don't have in other investments. So it makes it expensive, it makes it inefficient, it makes it take a long time, and just increase your risks. The second one I would just focus on are those transaction costs. Well, what are those? So typically when we buy a property, the first thing we do is we get a loan. okay, you're going to pay a fee for the loan. Okay, so you got the fee for the loan. Then you're going to have an appraisal. Okay, so you got to pay for that appraisal. Then you're going to have an inspection of the property. Then you're going to have to go to closing, and you're going to have closing costs. You're going to have title insurance and more fees like that you're going to have. If it's a commercial asset, you're going to have environmental inspections that you have to accomplish, and probably other holding fees and things like that you're going to encounter in the transaction itself. The third one I would say is lack of liquidity. It's just difficult. It takes a long time to sell the asset. So if you're going to need that money quickly, this is not the investment that you're going to make in order to turn around and sell it quickly. It takes a long time. You have to market the product, and it's going to take generally 60 to 90 days to get interest in the product, and then another 60 to 90 days in order to get it closed. It just takes time. There is a lack of liquidity in real estate. There's also this restricted information flow. It's just difficult to find investments. You're relying upon brokers generally, very difficult to use sort of databases that are out there. It's a very scattered market, and so it's not easy to go to one place to find everything that's for sale that you would find appealing. So it's difficult to find that investment that you're going to find attractive. And that's the role of the broker. And so the broker needs to be able to have that expertise to help you, to listen to you, and to go out and find that. And not that easy to find. And then there are just a limited number of buyers and sellers in any market. So it just makes it lack of transactions. There aren't that many transactions for us to choose from. So those are some of the disadvantages. It's a long-term investment. We make money over time in real estate. It takes time in order for us to pay down the debt, and we're going to have expenses and interest in that. So it makes it a long-term investment to capitalize on that appreciation that we talked about. And so it's really the time and investment that really will be productive for you. Then we have management requirements. This, unlike a stock, will require somebody to manage that asset, whether it's you or whether you hire a property manager. At any rate, you've got to manage the property manager, or you've got to manage the asset. And so it's not going to be something that doesn't require any time. So there are management requirements when it comes to real estate that I would consider a disadvantage. Property hazards. We just had a big windstorm that caused a significant amount of damage to roofs and to structures, and just the amount of money that it costs to clear the debris from the trees. And so we don't think about even not necessarily that severe storms causing damage, but they do. So we have what we call property hazards, things that happen: tornadoes, hurricanes, floods, fires. All those types of things will impact these assets that we have to watch for, and we have to be careful of, and just protect ourselves by insurance. Government restrictions and legislation. This is something that changes rapidly. We're going to see in the future changes in tax code. We're going to see changes in municipal code. We're going to see changes that are going to affect the ownership of these assets. So we need to understand going in that this could happen. There could be changes in zoning. There could be changes that would change our investment and possibly even our profitability of the asset. So we need to understand that real estate has some effect by government restrictions and legislation. And then just change itself. We're going to see a lot of change. Those of us that invested in office products coming out of the pandemic has not been a very profitable venture. And the reason is because people during the pandemic went home, and so we adjusted our workforce to a model that people worked from home. They are coming back. They are not coming back totally. We're going to guess that somewhere maybe 80% of them have come back. And then a lot of them came back in a limited capacity. They're working some at home and some in the office. So that's going to have a huge effect on the square footage of offices that we actually occupy and that need to be occupied from our people. So I think we need to consider those changes, that those are going to take place. They're going to happen. That's just one example. There's been a lot of them that change. So what are some comparisons of some other things that people could do with their money other than real estate? In other words, what's the competition for the investment of real estate? So I've got a list I kind of thought of. The first one I think of are precious metals. So you could invest in gold, silver, nickel, whatever the precious metal might be, diamonds, those types of things. Here's the biggest drawback to that investment that I can think of. Number one is I think it's going to be very difficult to leverage that. In other words, applying leverage means getting a loan. So using other people's money in order to fund your investment. It's going to be very difficult to go to the bank and ask them to give you a loan to go buy gold, silver, or any of those precious metals. So I think that's one of them that you might get for another reason, but probably not investment in lieu of real estate. Investment in self. I like this one. You might take that money and you might get a degree. You might get a certification. There might be something that you could do to make yourself better, make yourself more competitive in the marketplace or in your career, or something that you could do for the money. That one, I think you can make a justification for, and how much more income you could get than what you're able to get in rents off of a real estate product. Bonds. Certain time periods, bonds make a lot of sense. Other periods, they don't. So at times, these might be pretty decent alternatives to a real estate investment. But I will tell you, you would nearly have to compare that to a cash investment that you would make, because you're not going to get a loan from a bank on a bond. So not very comparable in that way. I'm not saying bonds are not good investments and you shouldn't have them in your portfolio, but they're probably not a competitive to real estate because of the fact that you can't leverage it. You can't get money borrowed in order to buy bonds. Mortgages. You could buy mortgages, and that's a real estate play of sort. So mortgages might be a good idea. Again, you're going to use cash in order to buy these, and then you're going to get interest payments on those mortgages. Stocks. I talked about that a minute ago when I said this is something that you put in the hands of some type of an investment broker or an investment house that would make the decisions or help you make those decisions. It's a simpler way to invest money and get a return. But again, you're not going to get a banker to loan you money to buy stock. It's probably not going to happen. But it is a passive investment that you would consider to have in your portfolio, but you would have to compare that to a cash investment on the real estate side. Commodities. When we talk about commodities, we're talking about oil, corn, the things that we have to have every day. And those might be interesting investments as well during certain periods of inflation, certainly, that you would look at. Certificate of deposits, again, that's a cash investment that you put in that's tied up for a bit of time that you get a return on. Not going to leverage that either. Nobody's going to give you money to go and buy CDs. And then the last one that I would talk about are collectibles. I've got a cousin that bought Ferraris as an investment. There are some investments. I've bought some things, collectibles. None of them have been terribly good investments, but they have been fun. So there are advantages to a collectible that you might take an active role in, that might be fun for you and be an activity for you and your family or with somebody that might be fun. But again, all of these, or I would say none of these, are really, in my opinion, a competitive investment to real estate. Real estate stands on its own for those reasons that we talked about earlier, those 4 reasons, which are income. You can get income from it via rents. The second one is appreciation. We know that it's, we know that it's going to be somewhat in line with inflation and protect us against inflation somewhat. The third one is that equity gain, that piece of the payment that you pay and the principal that's going to go to your balance sheet that goes to equity in that product. You're going to become the owner over time with no mortgage. And then the last one, the value gain, your input, your skill going into making that worth more money. So then the last part that I want to talk about is sort of the value of land and sort of the risks in investing in land, raw land. So what does it take for land to be profitable? What can we do with land? We think of land as an appreciating asset. That's really the way that land makes money, is over time, the increase in value based on scarcity or just over time. So what's really beneficial, though, is if you can find something to do with it in the meantime to make income. So what can we do with raw land in the meantime? Julie and I owned an asset on a corner in a town called Edmond, Oklahoma, and we used it, rented it to a food truck, and they made a little food truck plaza there, and we made monthly income for several years on that asset. And it was enough to pay for the taxes, the insurance, and a little bit of profit. Along with the appreciation, that turned out to be one of our best investments ever. So land can be a good investment, but you need to understand that you have to do something to it, whether you in some way cultivate it, you mine it, you drill it, or develop it. In some way, you have to use that land over time, or you're going to have some issues with holding costs. Well, holding costs, what is a holding cost? A holding cost is the payment that you're paying on it, or if you paid cash for it, what we call opportunity costs, that you could have invested that money in somewhere else to make income. So that's the first couple things. Insurance, you better insure that property. You still have a liability for somebody that's on that property. So we want to be very careful that we have the proper insurance on a piece of raw land to protect you. So those are sort of some of and then the taxes. You got to pay property tax on it. So you got property tax, insurance, and opportunity costs that you could have done somewhere else to make income. So think about those when you buy raw land. And when we buy raw land, how do you know where to buy raw land? You know, how can raw land be a decent investment? This is where we go into and start thinking a lot about working patterns. Where do people work? What causes people to increase in population in certain areas? And traffic patterns. Where do the roads go? The sidewalks go? The bicycle lanes go? What type of activity counts do we have in different categories of transportation along that piece of land? Will determine what we could put there and what we can put there. Zoning, codes, those types of things determine the value of the land. And then ultimately, what would you do on that land as far as development? What would you put there that you could gain income, that you could sell it for additional money? So those are some of the ways, some of the considerations when we talk about raw land. When we talk about categories of land use, you're gonna see this going forward in your career in real estate. We'll talk about single-family residential. We'll talk about multifamily residential, which is typically apartments, commercial land, industrial land, and then also in commercial we have retail, we have office, special uses, and those types of things. So what are the things that we look at when we acquire property and do you need to think about and consider? Well, the first one I would tell you is the purchase price. You can't ever change the purchase price of something that you pay for. So that negotiation that you do when you buy the asset needs to be considered, and you need to take some time to figure out and analyze what you can pay for something that you can live with once you buy that asset. The second thing, it's going to cost you money for the search to go out and find a property. So you need to allocate time and resources, including money, as the cost for the search. That just means you're choosing a broker, using a broker, or whether you don't use a broker. It's going to be time and effort and money to find the particular thing that you make the offer on with that purchase price. Consider the cash price, and consider if you have the money or if you can pay cash for something. Consider the advantages in paying cash and consider the disadvantages, the opportunity losses and costs that paying cash means when you buy real estate. And then if you can't pay cash, and that doesn't make sense to pay cash, what does the cost structure and the time look like in order to acquire the loan? When you acquire a loan, you're going to have a fee for the bank. Then you're going to have interest payments going forward, but you're also going to have to provide them with an environmental on the land, so that they'll go in and do what we call a phase one that will protect the lender and protect you once you buy that land going forward, if there ever was an environmental problem with that land. So that's one. Secondly, there's going to be an appraisal. So because this land or this asset, this building, whatever it is going to be used as collateral for the loan. So the what we call loan to value, LTV, is going to be a function. That's how much the bank is willing to loan you, is going to be a function of the contract price and the appraisal. And so we've got to get that appraisal, and that's going to cost some money and some time. So we've got to consider that when we're buying real property, is the appraisal. Taxes. Taxes, we've got to look at the property tax and see if it's in an opportunity zone, see if it's in a TIF. That's another thing that can have, which is a tax increment financing area. We'll talk about that more later. We'll talk about property tax later. We'll talk about a lot of these things later, but just in general, you need to consider property tax, interest that you're going to pay on the loan if you don't pay cash. You need to think about maintenance, the upkeep going forward on these things. We need to have some sort of a fund or resources available to do these things. Utilities. We need to understand what utilities are paid for by the owner and then by the tenant. And lastly, insurance. Insurance is one of those things right now that's getting very difficult, particularly in the United States. And so we look at what's the insurance going to cost, and then what's our deductible going to be. And you want to pick that proper deductible that will keep your premium as low as possible, but also protect the risk in the asset for you going forward. So those are some of the things to think about and to consider when acquiring real estate or real property. So we do what we call a feasibility report or feasibility study. That's just a study that will basically kind of consider everything that I've talked about this morning. So you want to be able to put all that into some sort of a report or a document so that you can look at it and you can analyze it and you consider, in the end, what else could I do with my money that would be an option. And we call that an option cost. So what else could you do? Now you can look at, after you put all this together, now you can say, okay, it does make sense to do real estate, or maybe I'd be better off by investing in the stock market or something else. But until you do that feasibility report and you consider all the things that we've talked about here, it just doesn't, you just don't know. Lastly, I want to talk about organization costs. In order to own real estate, you really need to set up some sort of an entity or an organization in order to hold those assets to protect you going forward from liability. You're going to have some legal costs in doing that. You're going to have some accounting fees going forward in doing that. If you're going to build something and develop something on raw land, you're going to have architectural, engineering costs, finance charges, closing costs. When you sell it, you're going to have disposal costs. You're going to have commissions in order to sell it. All these kinds of things are going to be wrapped up in this organization. And typically what we use is either some kind of a limited partnership or an LLC, are typical ones we see. Other alternatives that we don't see so much are S Corps and C Corps. So those are some of the entities that we'll talk about later going forward. So what I've done here over the last few minutes is just kind of give you some ideas of things that we're going to talk about more. And we're going to dive in and take a little bit deeper dive into some of these things. But I just wanted to kind of give you a brief overview this morning of some of the considerations and why people invest in real estate. So I thank you for your time. And if you have any questions, let me know. You can reach me at jdavidchapman.com. jdavidchapman.com. Thank you.